Welcome to the What to Watch video update. This is the last video that I do over the weekend where I pull out the charts that seem to be telling us something and I put them into one of three categories: a positive, a negative, and then those things that we're just keeping an eye on. Now, things are looking fairly positive for the market right now. In the upcoming week, the Fed is most likely going to cut interest rates by 25 basis points or a quarter of a percent. And the market's been building up to that. And now, is that going to be a buy the rumor, sell the news kind of event? And lately, over the last couple of years, anyway, as the Fed's getting ready to cut rates, we've been seeing the 10-year yield going down. And then after they cut rates, it goes back up. Well, we're kind of seeing the 10-year yield going back up, and this is before the Fed has made their announcement. Is there some kind of a message in there? Now, interest rates on the 10-year yield are not a real problem for the market. Stocks are not really focused on that as much right now, but we'll just keep an eye on that nonetheless. But we are looking positive overall. But last week was just a real comatose week. But December ends up usually from a historical perspective, it's positive and it does okay in the first part. Where it really tends to do better is in the second half. Now, is that going to be a fake out? We just barely made November positive, and that was just because of the nice big up move we saw during Thanksgiving. And that's usually the best performing month of the whole year. So we don't want to take anything for granted. We want to really just focus on what we're seeing and as it develops day by day. And we're asking the question this week, will a rate cut help set new all-time highs? Now with the S&P, we're less than a percent away. We're like half a percent away. I've got an actual chart to show you later from setting a new all-time high on a closing basis. In the past week, the Russell 2000 small cap index set a new all-time high, but that was not confirmed by the Russell 600 small cap index. So a little bit of a discrepancy there. And this is being prepared for Monday, December 8th. So before I get into that, from now until the end of December, I have a program called the SPX Investing Program. There's additional information that I post there, and you have immediate access to the videos. And that's the way these videos are really designed, was to be viewed as soon as they're available, or they're delayed on YouTube and Rumble. So feel free to check that out. All you need is an email address, and that's it. And if you decide that you like it, well, you just can choose to continue. If not, well, just unsubscribe and be on your way and just see if what I do is of any help to you at all. Okay, let's look at the positive side first. Now, we had an up week, not by very much, 0.31% overall, but it was still an up week nonetheless. And it's really been choppy lately. The market's really lacked a lot of conviction. It doesn't seem to have that overall just power that it's had previously. Maybe that will come back. We're starting to get economic reports coming out again. They're pretty favorable for the economy. And it looks like the Fed's going to cut rates, as I said before. And things are looking positive overall, but there's just not an awful lot of intraday conviction here, where we went up and then came back down. We actually gapped lower on Monday, but then got some of that back, but then closed down near the lows. Very choppy on Tuesday. Saw a bit of an up move here on Wednesday, but then saw some selling going into the close. Very choppy on Thursday. And then this was a little bit of a disappointment because we had the core PCE come out on Friday, and that was a market-friendly report. The inflation component actually came in less than expected, and it looked like, okay, maybe we're going to be off to the races, and we're going to really go up here and establish some real upward momentum. Well, we did, at least for a little while. We just kind of went up and then just stalled out a little above this R2 level and then gave most of those gains back, went all the way down to the unchanged level, and then just chopped around and drifted down going into the close. So yeah, it was an up week, but it wasn't a week full of conviction. But it wasn't a week full of doom and gloom either. It's like the market's holding up right now, but it's not showing a lot of offensive, really strong strength. Okay, so now one thing I've been pointing out here with the daily chart is it does appear we're trying to get rid of these lower highs that we've been seeing. We've been drifting up a bit here, not very far from the all-time high. And this is looking a little bit better after it looked like we were coming up to this level, setting a lower high, and then we could have gone down from here. Nope, we've been able to chop back up from here. We're still well above the 50-day moving average. We are in an uptrend with the 50-day above the 200, but we continue to be below average with volume. We'll see if that picks up in the upcoming week. All right, and we are improving. Now we're still negative overall when we look at fear and greed, the index here. But when we had that big down day on November 20th, we got all the way down to 6. And so we've been improving. And now that we're out of this extreme negative territory, we tend to go with what sentiment is doing. A little bit flat here after Friday, but this is looking better. And if anything, the fact that when we were going down, sentiment was so negative, that probably ended up helping the market because a lot of people were already hedged and they were already expecting the market to go down more. And that's usually when it does the opposite of that. And so that probably helped things overall. We had about a 5.5% decline from the all-time high on an intraday basis to the low that we set during that downward move the week before Thanksgiving. And that's just a normal pullback. You would have thought it was the end of the world by some of the things you were hearing out there, but no, it seemed to be holding together for the most part. And this is improving. So this is taken as more positive with the sentiment. And for the first time in a while now, we're actually getting a positive read from individual investors. This is a weekly survey that comes out. We're above zero, coming in at 13.5 right now, not extreme positive. Now, they never became extreme negative, but they were negative overall. They were giving us a negative reading. The moving average is still negative. This is looking over the last 50 periods. So we're going to need to see a little bit of recovery there to see more of a sustained uptrend. But this is improving, and now it's finally turned positive. And we are positive with the VIX. We're below 20 and declining. We're also below the moving average here with the line chart. That's the closing value. And we're also below with the bar chart, which is the open, high, low, close. And we're positive here with the shorter term moving averages of 10, 20, and 30. We're above all the lines. And then this green line is actually starting to climb back above. It moves the quickest, and it suggests that we're looking more positive when the green line is on top. And so that is looking much better there. We're also looking okay with the short-term trend. I base it around 20 periods. I know some folks use 19 or 21, 22 and a half, whatever. I've just settled on 20 decades ago and just stuck with that. And we're seeing the green line and the blue line going up and prices above both. And so the short-term trend is still looking fairly solid for right now. And we're also looking good with the intermediate term trend, and it's starting to improve. The blue line and the red line are going up, and prices above both. So that's showing an improvement. And we're positive here when we measure the distance above the 200-day simple moving average. But the one thing we want to be aware of is when we get above this 10% level, that sometimes suggests the S&P is overextended. But you can see we've spent a lot of the last couple of months above this 10% level. This is the downward move that we saw going into November. And then we came right back up and we're getting a high reading here again. So we just want to be aware of this. It's not predicting anything. It's just other more substantial declines than what we did see came when this was more than 10% above the 200-day moving average for the S&P. And then here it is. I was wrong by that. We're 0.3% away from the all-time high on a closing basis. So that's pretty close. We have a bit of an up day. We close up. We have a shot at generating a new all-time high there. And we're looking okay, but not showing an awful lot of strength here. But there is some positive things from the advanced decline line. We're not really breaking out here based on price, but we are breaking out and setting a new high based on volume. That tends to be more positive. When we see volume actually leading price, that can often be a good sign. And in the bigger picture, we are positive. We're above these moving averages and looking pretty good there. And the advanced decline oscillator, which looks over the last 10 periods, we're above zero and going up. That's positive. Now, be aware, we are above this red line. This is the 100 level. And it doesn't mean we'll stop right here. It just means this is when we pay more attention to this, because sometimes when we get an extreme reading, it doesn't necessarily mean a reversal. It just means that we might slow down for a while. You can see the other extreme readings that we had. It didn't mean things were going to turn and go the other way. But we've already been rather comatose as far as the conviction in the market. And if this reading goes up and then comes back down, are we going to become even more comatose as far as market action? And then the new highs and new lows internally were looking pretty good. We're seeing an expansion of the new highs, a little bit of an expansion of the new lows, but a lot more green than red. And so we're still going up with the 5-day chart and the 10-day chart. So this is showing internally the S&P is looking pretty solid. And the smart money indicator is a bit of a mixed picture here. We're still positive in the bigger picture with accumulation distribution. We're above the moving average. And we're kind of flattening here, but we're still above the moving average shorter term with the boom indicator. And we're positive with the Chaikin money flow. Unfortunately, our third smart money indicator is going to be over on the negative side. And the vortex, it is positive. It was really choppy in there. It seems like it's getting a bit more conviction now with the green line going up and the red line going down. If this could continue to go up and the red line to continue to go down, that would be even more positive. And now looking at the trend, we're trying to develop a bit of a trend here. We're turning up slightly with the ADX, but we're not way above the moving average yet. So it's like, and when I look at charts, I don't want to have to use a magnifying glass to see it. I want to be able to look at the full chart and have it tell me what is actually being presented here. So we are turning up, so that's encouraging, but we're not really moving across the moving average all that much. But we are positive since the green line is above the red line. However, we're still below 20. So it's a weak trend. It could be the beginning of a trend. And we're seeing a start here in the short term where it's still trying to think about things in the intermediate term, which I'll show you in a moment. But it's been picking up a lot of this lack of conviction. And then for the strategies that I've been implementing during this time are market neutral, and where we don't think the market's going to go up very much or down very much. It's going to chop sideways, and those can be very profitable strategies when implemented at the right time. And we look at the intermediate term trend, trying to go up a little bit here, but not showing an awful lot of conviction, but we still default to positive with the green line above the red line. Then we look at the weekly chart. We're still going down with the ADX. It's below its moving average, but we also default to positive here with the green line above the red line as well. And then we look at our rainbows. And I've been trying to point this out in different videos where this is the short-term rainbow from 10 periods to 50 periods with simple moving averages. We came down here, but we didn't stay very long. But we were down here long enough to start to jumble up some of the lines here. Now we're getting back above the rainbow, and the more we stay above this, the more the lines will turn up. And then with the hope at some point that they'll smooth out like they were earlier on here, and we can see that, yeah, the short-term trend is comfortably positive. It's improving here, but it's not as positive as what we had been seeing earlier on. Intermediate term rainbow, going from 50 periods up to 100 periods. We came all the way down to the 100 period moving average and then bounced up off of that. And this was a pretty short stay. And so we came back up out of the rainbow, and it really didn't give the moving averages a chance to roll over. They're still continuing to go up. And the long-term rainbow, going from 50 periods up to 250 periods, came down into the rainbow, got back up out of it quickly. The lines are going up, and we're seeing even some of these longer-term lines start to improve after really hitting some lows back earlier last spring. And then all the plotted moving averages that I have here, we're above the 20, 50, 100, and 200. And so we're positive on all three time frames. Moving averages are what I use to determine if we're positive or negative. And we're still okay here, seeing a little bit of weakness. The McClellan oscillator for the S&P, it was getting an extreme reading to the upside, and it's fallen back a little bit, but it's still positive since it's above zero, even though the context is showing a little bit of weakness here. And when that is above zero, the summation index, the McClellan oscillator feeds into the summation index. So when it's positive, the summation index is going up based on price and volume, where this previous chart, this is more short to a little bit intermediate term, where this is more intermediate term here, and even a little bit longer term when this thing really gets moving and staying in one direction for an extended period of time. So the fact that this is going up is positive. Also seeing a little bit of weakness here with the broader market NYSE McClellan oscillator, but it also is still above zero. So we continue to go up with the summation index for the NYSE based on price and volume. And this is looking pretty good. The risk on to risk off ratio, we were coming down here as we were hitting some bumps during November, but now this is starting to go back up. Not quite back up to this previous high yet, but this has been improving. And the context in the bigger picture is that this has been going up, and that is positive. And we're positive with the daily parabolic SAR chart. Now, unfortunately, on the weekly side, we haven't seen enough of an upward move yet to turn that from negative to positive. But here on the daily side, when the dots are underneath, that is a positive reading. And our momentum is turning over in the short, intermediate, and long term. They're all crossing above their moving averages, even the longer term ones, and we're going up. So we're seeing confirmation across the board here. We're also positive with the Copic curve momentum oscillator. And we're above 50 and we continue to go up here. We declined a bit on Friday, but we're still above the moving average. So this is still treated as positive with the bullish percent index for the S&P. And we're going up with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. And then those stocks in the S&P above their 20 period moving averages, seeing some weakness here, but we're positive since we're still above 50. Now, if we see this continue to come down, we might change that because the context would turn to more negative overall in the short term. And then here's the daily special K chart, a very long-term oscillator. A week ago when I did this video, we were coming down here. Now it's starting to turn back up. And we never did go negative. We only go negative if we drop below the red line. So it was still positive, but showing some weakness. Now it's showing some improvement. Then here's a weekly special K chart where we never did really roll over here. This is still looking quite positive in the longer term. And even though we're not breaking above the 50 level with any real enthusiasm, and we declined a little bit on Friday, we're still above 50 here with the stocks inside the S&P above their 50 period moving average study. Still looking positive with the 100 period moving average study and the 200. This is actually a little bit more encouraging. This is going up with a little bit more conviction and is further above the 50 level as well. And we're still doing okay here. We were up 0.31% for the week. We have overhead resistance at around the 7,000 level if we get up to that level. And then we have some support here at about the 6,500 level. So, I mean, it's a 500 point range right there. We'll see if that even comes into play at some point. But this chart is still looking positive. And this is longer term and showing the internals for the S&P, a 10-day average of the highs and lows for the S&P. We're getting a reading above 90, and that's showing good long-term momentum. When it's really positive is when we go above this green line and we just camp up here for a while. That's when the market is really moving. So this is positive, but we would like to see more follow through with this so that this reading stays high. Also improving with an even longer term measure. This is a 50 period moving average. The previous chart was 10. This is 50. And after we had been declining, we're starting to go back up. Now, we never turned negative because we were still above zero, but we were seeing some weakness. Now this is improving longer term. And then the Pring bottom fisher, this generated a buy signal right at the beginning of December, where a week ago this wasn't generating anything. Now it's starting to come up here. And again, you might use this as some kind of an indication that you might want to do some buying. I think of this as a novelty type of indicator. It is positive, so that's why I'm showing it. But it's given some pretty good signals over the course of time, but it's also given some not very good signals as well. And then we're looking okay here with the advanced decline line across the NYSE common stock, the S&P mid caps and small caps. We did decline a little bit in Friday's session with the small caps, but we're above the moving averages with all the indexes. And we're holding up okay here now. So when I get over to the negative side, it's going to be the growth of value that I'm really going to dive into. And it's not that it's falling apart, it's just not showing the real leadership. Well, this is still holding up okay with the large cap growth ETF. A little further to go to get back to the all-time high, but we're above the 50 and 100 moving averages here and the 200. So I mean, this is far from negative. We would just like to see a little bit more conviction with this actually going up. And then another broad market measure, we look at a 5 period moving average of the highs and lows across the Amex, NASDAQ, and NYSE. We're above zero and climbing. The more this goes up, that's longer term and broader than just the S&P, and that would continue to be positive. And then the transports, my goodness, they're breaking out here. We broke above this other resistance level that we kind of were getting close to, and then this is a previous high set in right here, and we're dealing now with this high set back in late 2021. We have a ways to go to get back to the high set in 2024, and after we set that high, then everything just kind of crumbled after that. But this is really improving, and this could be some of the character that's changing in the market. Now, one of the yellow flags, not red flags, but yellow flags that I've been watching is the growth of value. Well, we're seeing some things change, like the transports. They've been doing nothing here. I mean, they weren't falling apart, but they weren't really outperforming the Dow itself. Now, lately, they have been outperforming the Dow, and this is an improvement that we haven't seen in quite some time. And then here is the Dow. The Dow's the black line, and we're really coming up here with the red line, which are the transports, even though they're on different scales. When we see some really solid upward move, it's when the red line is above the black line. Now, we've spent a lot of time with the red line below the black line, and the black line's still going up. So it's not a hard and fast rule. We're just wondering if the overall character of the market might be changing and more beneficial to things like the transports and to small caps. And the Dow, not too far from an all-time high, but not showing an awful lot of conviction either. In an uptrend, still above its 50-day moving average. The Nasdaq, a ways to go to get back to its all-time high, but above its 50-day moving average. We're above this pivot point here for December. And when we're above that, that's taken as positive. If we drop below that, that would turn things more negative. So we're looking positive here. And the NASDAQ 100 also above the pivot point, going up, a ways to go to get back to its all-time high. And the momentum for the NASDAQ 100, as measured by the PPO, that is still positive. And when we look at small cap growth to value, this has been pretty strong. Now we were really surging up here with the growth to value ratio, but the S&P 600s were the 600 index here. It just wasn't really doing much of anything. And then it showed some weakness as we were going down. And we're not really breaking out here with this small cap index. We have a ways to go to get back to the 2024 highs that were set. But I mean, this is far from negative, but it's we want to see more follow through here. But the growth to value ratio is looking quite good. And then here's the S&P 600 small caps. Now we've been back to this high before. Is this going to produce some kind of a double top in the short term here? And we've been to these prices before. We need to see a pretty substantial up move to get back to that previous all-time high. And now this is the one that set an all-time high on Thursday, but it gave some of that back on Friday. This is the Russell 2000 small cap index. We're still above 50 with the RSI, even though we rolled over a bit on Friday. And we're going up with the MACD. So this chart is looking fairly positive right now. And the mid caps not really breaking out of this range of recent prices. And if you watch the deep dive video, I rank the different indexes that we follow. And for a number of weeks, if not a few months now, the mid caps have been coming in last place. So they're not really performing all that well, but they are above 50 on the scale that we use. And so that's an improvement. And they are above their 50-day moving average, and they are in an uptrend. And then the Wilshire 5000. This is a broad market measure, not quite back to an all-time high, doing well, but not really showing a lot of conviction. The total U.S. stock ETF, a bit to go here to get back to its all-time high, above its 50-day moving average, in an uptrend there. The FANG index, this is the area that needs to really catch on fire to really move. These are the really big stocks like Facebook, Apple, Amazon, Netflix, Google, Nvidia, and some other ones. We're just kind of hanging out a little bit above the 50-day moving average, which is hardly negative, but we're not seeing any real strength right now. And we are in a bigger picture uptrend here, but this would be nice if this was really to move to the upside. And the Dow Jones Semiconductors. Now, the semiconductors are doing okay. We have a ways to go to get back to an all-time high here with the Dow Jones Semiconductor Index, but we are above the 50-day moving average. And then we look at the SMH semiconductor ETF. It's doing much better. It actually outperformed this week and is a little bit closer to setting an all-time high and a little bit further above its 50-day moving average. Then this is that same ETF, but just showing the closing prices, how we're coming back up out of the rainbow and improving there. Now, this is a weekly chart of the Dow Jones Semiconductor Index. Another thing, if you remember back, the S&P is more than 10% above its 200-day simple moving average. This is a weekly chart, and we're more than 100% away from the 200-day moving average here. But we've been here before, and then we come back down, and then we go back up. So it's not necessarily predicting anything. We just want to know about this, and it's on the positive side because it's giving us a good solid reading. But when we get above this 100% level, and when we do start to see a decline, the more meaningful declines typically start when we're getting a very high reading here. And we just barely came back down to the 10% level with the declines that we were seeing back in November. This is looking good. This is back to a daily chart here. This is the semi to tech ratio. Now, tech is doing good, but when semis are doing even better, even though they fell back a bit on Thursday and a little bit of a tick up on Friday, but the overall context is that this is going up when the semis are leading, that's a good thing and a positive thing for the market. And we look at a semi to Dow ratio, and we're still well above this blue line. We're not quite back to an all-time high, but not far from setting a new one with this ratio. And then we look at a weekly chart of the NASDAQ 100. We're back above this trend line going back to 2009 after we spent a bit of time below it. And the NASDAQ 100 to Dow ratio still looking pretty solid here. Growth outperforming value that way. And then the QQQs, which is the NASDAQ 100 to small caps, not as strong with this ratio, but still well above this blue line. And we look at the staples to tech ratio, which had been going up as the market was going down. Now we're starting to decline again here. And the bigger picture context is that we have been declining. And when the staples are underperforming the tech sector, that's positive for the market. And so we're seeing a bit of an improvement here with this chart. And we're also improving here. Now this one's actually going up. This is the S&P is first in the ratio, and then utilities. It's not really breaking out, and it's not that we're seeing a lot of strength right now in the S&P. We saw a lot of weakness recently with utilities, and that's causing this ratio to go back up. But there's not enough, a lot of confusion here, but this is trying to improve. We'll see if there's any more follow through with this. And now it looks like we're not going to get a confirmation. Now, even though this had to be triggered by Friday, which was December 5th, there's a 1 day lag here. You notice over here the date is December 4th. This won't be updated until after the close on Monday. But we were below volume or below average with volume. We didn't have a really solid update. We gave up a lot of the gains. The it just wasn't all that strong of a day on Friday. So it's probably not going to trigger a Zwag NYSE breadth thrust. But this can still be positive in and of itself. We had this extreme negative reading back on November 20th, and we've really come up out of that nicely. So even if it doesn't get all the way up to the red line, unless we see weakness developing in other areas, this is still looking quite positive. And we're still, these usually last a year once they're triggered. This is what we've been working off of. This was the extreme negative reading that we had back in April. And then we had a thrust up here to the red line on April 24th. And we've been riding that wave ever since. And so that one's still in play right now. We were just wondering if we were going to get another one here. And then we look at, and I only have a couple of charts here. I usually show many charts, but I wanted to limit the charts that I show in this video this time. This is a stock to bond ratio, and we're looking okay, not quite back to the all-time high here, with the S&P outperforming 3 to 7 year bonds. And we're above the rainbow again. And when we're going up the way we have been, that means the market is anticipating a soft landing, meaning that we're not going to go into a recession. And this is an inverted version of that same chart, how bonds are back now to underperforming stocks, the S&P, where when we were coming down in November, this ratio was starting to go back up, even though the bigger picture context was that we were declining, and now we're back to declining again. And home construction, this is improving. It's not showing an awful lot of conviction here. Now, this is a very interest rate sensitive area of the market. And if they cut rates, the anticipation of that is what's been helping this ratio to go up. But it's not a real strong looking chart, but I have it on the positive side because we're at the top end of the rainbow. If this can turn around and go up, clear the rainbow and see the line start to go back up, that would be even more positive. And we're declining here with the staples, which was toilet paper and toothpaste, defensive versus the S&P. When this ratio is going down, that's positive. We were going back up in November. Now we're starting to come back down again. High beta to low beta. This is almost setting a new high here with this ratio, and that's positive for the market. And this is looking better, not really strong, but better, the S&P to Staples ratio. And I keep an eye on this because this gave us a heads up at the end of 2021. This rolled over and really started to go down, and then we set a new all-time high after that in the beginning of 2022, and then we went into the bear market that we lasted until October of 2022, and then we started to see an improvement here as we got into 2023. Of course, everything went crazy last spring with all the tariff freak out and everything, the Liberation Day. But this has been really improving. It was pulling back into the rainbow before. It's trying to improve here. And if this continues to go up, that'll be even more positive for the market. And then here we have positive seasonality going into the end of the year. The first half of December does okay. It's usually the second half of December that tends to perform better. Now the negative side here, and I'm dealing with growth of value. And it's not that this is falling apart. It's not that it's totally negative. It's just not showing a leadership right now. Now we're going up here with the red line and the blue line, but we would like to see the blue line above the red line, meaning the growth is outperforming value on an intraday basis. Now, the bigger picture context, if you go all the way back to the end of June, is that we've been going up. Then we ran into some trouble here in November, and now we're starting to go up again. So this chart is hardly negative. We would just like to see the blue line start to outperform the red line. That would be even more positive. And this is okay, but not great. This is a 10-minute intraday chart of growth to value for the S&P. And we've just been chopping along, going sideways, not really seeing any conviction here. It doesn't mean the market's going to fall apart, but this isn't the real strength that we saw like back in October. This thing was just on fire. And then we started to see some weaknesses. We came into November, and we haven't really been able to get that strength back to really see this outperforming. And now, this is a little different than I usually do. I do this in the intermarket analysis video. That's also another weekly video that I do. But I wanted to just kind of break this down a little bit. This is hard, not negative, but not as positive as we'd like it to be. What you see here is the pure growth index for the S&P. Looking pretty good here. We came down to the 200-day moving average. We came back up, and we're now back dealing with the 50-day moving average. Nothing really negative here. Could be stronger than it is. Having a ways to go to get back to its previous high here. And then it spent a lot of the summer just kind of chopping along sideways. So this is not negative. It could be better, but it's not really a negative looking chart either. Now, this is the value. Notice how we're way above the 50-day moving average and we're really moving up here. This is value really outperforming. And you can just think back to the previous chart and go, okay, back here, we're at the 50-day moving average. With the value chart, we're breaking above the 50-day moving average and really close to setting all-time highs with this index. That's not what you like to see in a real positive environment. It's not that it's totally negative, and it could be just a character shift that we're seeing in the market. But I've been seeing this now for quite some time, pointing it out, and it seems to just kind of build even more and more lately. Now, this is to kind of put them side by side instead of flipping back and forth. This is that same growth chart here coming up to the 50-day moving average, where the value chart is breaking above and near an all-time high with the value index here. So you can see just by looking at this the difference. Now, we also do a ratio, and I show this ratio in the intermarket analysis video. Not negative, growth is still outperforming value in the bigger picture, but we're just kind of trying to get back above the 50-day moving average here, not really showing any real conviction of strength. Now, that could change, but we've been watching this for a while now. We've been waiting for this to improve. It just hasn't been. And then this down here, I use inverted charts sometimes because we might see something in the inverted version of the chart that we missed with the regular chart, and this is one of those that this shows how value in the bigger picture is underperforming growth. Then this is S&P growth to value, and I show this in every daily video. This is probably the most concerning chart to me. When we were really coming up here out of the lows, growth was really outperforming value. We hit a top in August. We fell back. We could not get above the 50-day moving average. Then we fell below the 200-day moving average. Now we are improving, but we need this to get back above the moving averages to be more positive. And then this is that same chart, but longer term. And then I did a correlation down here just to show the correlation between the S&P and this ratio that we see here. And you can see we were much stronger back in late 2021. We never did get back to this level yet. I mean, it's still not really negative. We're in an uptrend, but we're below both of the moving averages here. And you can see that for the most part, the correlation between the top chart and the middle chart is usually pretty strong. It might have periods of time when they go in opposite directions, but we're showing a bit of a strength here. Now, if we could see both of these go up and this correlation continue to go up, meaning that they're going in the same direction at the same time, that would be more positive. So it's S&P growth to value that's I seem to be fixated on the most. Not that it's negative, it's just a yellow flag, not a red flag at this point. Also, this growth to value ratio, which has generally been more liberal, it's held up better. We've stayed above the rainbow longer here. We're just kind of chopping around at the high end of the rainbow right now. And then we look at some growth to value ratios. We are improving with the Qs to S&P. We're above the moving average, and the moving average is starting to turn up. That's okay. We're a little bit above the moving average when we look at discretionary to the S&P, but then when we compare large cap growth to value, we're under a declining moving average here. And then we look at the large caps improving, but still below a declining moving average, still below a declining average with the mid caps, but looking pretty solid here with the small cap growth to value ratio. And then mid cap growth to value. Now you remember back on the positive side, small cap growth to value was like way up here and looking really good. Mid cap growth is like the opposite in the negative way here. We're looking not so good and we're below both of the moving averages. Even though this is still in a longer term uptrend, we've really leveled out after this was showing some improvement. And the index itself just really isn't breaking out right now. And then discretionary to staples. We just cannot seem to get back above the 50-day moving average when we look at the equal weight discretionary versus the equal weight staples. And the reason why I use equal weight here is because Tesla and Amazon are in the discretionary sector, and those are two huge stocks, and these are weighted, and so we get a distorted picture sometimes. Well, when we use an equal weight version where all stocks are treated the same, sometimes that can be more insightful, but we just can't seem to get above the 50-day moving average. And we are declining here with the Swirling Trading Oscillator. And this has been happening the last few sessions. Declining here based on price, declining based on volume. If there's one positive with this chart, we're seeing volume or price going down quicker than we are volume. That could mean that volume is holding up a little bit better, which could be positive. And now on the weekly chart of the parabolic SAR, dots are on top, still negative here. And then this is the smart money indicator that we saw enough of a decline in Friday's session to drop below the moving average. The other two smart money indicators are positive. This one has now turned negative. And then the areas that we're watching here, and we saw just a massive drop off. With the weekly jobless claims, we've been pretty much range bound in the 220 range. We go a little bit above it, a little bit below it, and we fell all the way to 191. Now, that's great, and that's showing that there's not a lot of people are filing for initial unemployment jobless claims here. So this is showing that the employment situation is looking pretty strong. And then we want to keep an eye on continuing claims. They are declining. We're still below 2 million here, but you notice how earlier on in 2025 we were in a lower range and then we went up to a higher range. And even though we're declining, we're still up in this higher range. And this is suggesting that with the big drop in the previous chart, the companies are less willing to lay people off, But this chart suggests that those people that do get laid off tend to stay unemployed for longer. And we want to keep some context here. The red line, these are the initial claims. The blue line, those are the continuing claims. And then the unemployment rate is at 4.4%. And we want to always keep an eye on volume. Now, we've been below average, but we've been improving. You see how we're less below average, if that even makes sense there. So, but it's not really showing a real pickup there. And we're kind of going up to the upper end of this recent range with the 10-year yield. Now we were just under 4% the day before Thanksgiving. So it's not like we're breaking to the upside with interest rates. We just want to keep an eye on this. That's why I have it in the watching area. Not necessarily positive, not necessarily negative, but something we do want to watch. And then I'll just give you the takeaway here because there hasn't been that much of a change overall. This chart and then the two after this try to determine what's the market think as far as inflation and interest rates. And we're still going down here, even though it bounced back up with this ratio. This means the market's not worried about inflation or interest rates. Going down here with this other chart, not worried about inflation or interest rates. Going down, even though we bounced back up recently here with this chart. So we have three charts that are confirming, according to this, that the market's not worried about inflation or interest rates. And we're coming back up here. This means there's less risk. This is like a sentiment gauge in a way for the bond market. When this really falls, that means fear is just going up. This is an inverted chart. Well, this is going back up here. And so that means that fear is decreasing, and that is positive for the market. And then we look at the weighted version of the discretionary to staples on top. That's actually doing a little bit better here. The equal weight has been underperforming. So this is like Tesla and Amazon having more of an impact because Tesla had a pretty good week this past week. So that's why this ratio is going up and this one's pretty much flat. Now the tech to utilities ratio, now tech is doing okay, but utilities have been seeing some weakness. And so we saw a real nice up move here with this ratio and the biotech to healthcare. Woo! Now healthcare, it was the best performing asset in November. It was up 9%. Right before the end of the month, it was up 10%, but then we started to see some profit taking, and some of that profit taking is still happening. But that's why we're seeing this ratio coming up. Biotech, which is growth, has been outperforming healthcare, which has been going down lately. And we're seeing some weakness here after it had been improving when we look at hotels to utilities. This is another growth or discretionary to value or staples area. And this was improving, but now pulling back. And then we look at the bellwethers here. Semiconductors showing some improvement here. We would like to see more improvement from the home builders. They went up and then they've been going sideways. Transports, this is showing some strength right now. Retail showing a little bit of strength. And we are showing some improvement here with the regional banks. These are the smaller banks, and we want these to hold up and do well. And then we look at the correlation between Bitcoin, which is in red, which has really been under pressure. In fact, as I took this chart, we were back under the 90,000 level. We got back up into the 93 range, and now we're seeing a little bit of a pullback here. And then the correlation between the Bitcoin and the NASDAQ 100, it's coming up to showing a little bit of a strength. When I did this video a week ago, this was really coming down. Now the correlation is starting to pick up again because Bitcoin was going up and the NASDAQ 100 was going up, and this indicator was picking up the strength that they were moving in the same direction at the same time. And this is improving. This was on the negative side not too long ago. We were seeing momentum stocks really underperforming the S&P, and this started in early September and continued to go down, 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 down. We're now improving a little bit here. Just something we want to keep an eye on and see if that shows more of an improvement. And then this is the value line index here. It's kind of interesting where we set the all-time high back in late 2021, and we have yet to set a new all-time high since then. We got close up here earlier in 2025, but not quite. If this can continue to go up, is it going to come up to this line? Is this going to provide overhead resistance? Or are we going to be able to break through here and break this series of lower highs, at least in the shorter term, and then possibly keep going up. I don't base decisions around this, but when you have the other indexes like the Dow, the S&P, the Nasdaq 100, even the small caps, just coming off of all-time highs or recently setting all-time highs, and this is lagging behind, that's a little bit of a concern. But this has gone on now. We have to go all the way back to 2021 where the underperformance started. And 2022, we finally came out of that bear market. And then we had um, over 20% gains in 2023 and 2024. Right now, we're in double digit gains if we were to close right now for the S&P. So, I mean, those areas are positive. It's just a little bit of a concern when this is underperforming. And then we want to keep an eye on oil. It was going down into the high 50s. Now it's back up into the 60 range. Want to keep an eye on the dollar here. We're still in a downtrend and we're below that 100 level. The stock market likes a weaker dollar. And then here are the pivot points. They've already been posted on the YouTube community tab, and they also make them available on the website as well. And then we have the Hindenburg Almond here. All right. So perma bears love this thing and they consider it a done deal when we get just one spike, but that's not following the rules. And I'm putting them in a generic club here. And that's why I disregarded this indicator for many, many years because I first learned about it from a perma bear. And since they're wrong 70% of the time, I tend to fade whatever they say. If they say we're going down, well, it's pretty much a guarantee we're going up. And then the few times they are optimistic, it's like, okay, this is when I'm looking to sell right now. But we had the initial spike back in October. Now, one spike is not a Hindenburg almond. We need to have a spike, and then within 20 trading days after that first spike, we have to see another spike. Well, we've seen a series of spikes here, but lately we haven't seen much of anything. Now, this will finally fall off the books here, fall off the radar, if we get to around December 26th and we don't see another spike here. Then that'll negate what we're seeing right now. But I mean, this is, I'm recording this for December 8th. So we got some time here and a lot of things can happen. But I just wanted to and then if we see another spike, then I'll have to adjust this date again. So thank you. I hope you found this helpful. Have a really, really good weekend, and I will talk to you in the next video.